Today for the SIE exam, we are covering one of the most fundamental and frequently tested topics, the key differences between traditional and Roth IRAs. Understanding the tax treatment is everything here, as it dictates how contributions, growth, and withdrawals are handled. Let's start with the traditional IRA. Think of it as a tax-deferred account. For most people, contributions are made with pre-tax dollars, which means you may be able to deduct the contribution from your current year's income, lowering your tax bill today. For example, if you are in the 22% tax bracket and contribute the maximum of $7,000, you could save over $1,500 on your taxes for this year. The money inside the account then grows tax-deferred, meaning you don't pay any taxes on interest, dividends, or capital gains year after year. The trade-off comes at retirement. When you withdraw money from a traditional IRA, every dollar is treated as ordinary income and taxed at your marginal tax rate at that time. This is a classic exam trap. A question might describe a client who contributed $50,000 over their lifetime, which grew to $200,000. When they take a $20,000 distribution in retirement, the entire $20,000 is taxable, not just the growth. Now let's flip to the Roth IRA. The Roth operates in the exact opposite manner. Contributions are made with after-tax dollars, so you get no upfront tax deduction. A $7,000 contribution costs you the full $7,000 out of your net pay. The magic of the Roth happens on the back end. The account grows completely tax-free, and all qualified withdrawals in retirement are also 100% tax-free. So that same $200,000 account from our previous example, the entire $20,000 distribution is received with no tax liability. The exam will test this by asking which account provides tax-free withdrawals in retirement. The answer is the Roth IRA. To keep this straight, here's a simple phrase: pay the taxman today or tomorrow. With a traditional IRA, you defer taxes, paying him tomorrow. With a Roth IRA, you pay him today. Contribution limits are a critical area. For 2024, the maximum you can contribute to all of your IRAs combined, whether traditional or Roth, is $7,000. If you are age 50 or older, you can add a catch-up contribution of $1,000, bringing your total to $8,000. A common mistake is thinking you can put $7,000 in a traditional and another $7,000 in a Roth in the same year. This is not allowed. Your total contribution is capped at the annual limit across all IRA types. The exam will test this with a question about a 40-year-old who has already contributed $4,000 to their Roth IRA. The maximum they can then contribute to a traditional IRA for the same year is only $3,000. Income limits are another source of confusion. For Roth IRAs, your ability to contribute is phased out and eventually eliminated at higher income levels. While the exact modified adjusted gross income, or MAGI, numbers change, you must know that high-income earners are prohibited from making direct Roth contributions. For traditional IRAs, the income limit isn't about contributing, it's about deducting the contribution. Anyone with earned income can contribute to a traditional IRA. However, if you are also covered by a retirement plan at work, like a 401k, your ability to deduct the contribution is phased out as your income increases. Finally, let's talk about penalties. If you withdraw money from an IRA before age 59 and a half, you will generally face a 10% early withdrawal penalty on top of any ordinary income tax due. The exam loves to test the exceptions to this penalty. These include death, disability, a first-time home purchase up to $10,000, qualified higher education expenses, and certain medical costs. Remember, even if you qualify for an exception and avoid the 10% penalty, you still owe ordinary income tax on the pre-tax portion of the withdrawal from a traditional IRA. For a Roth IRA, you can always withdraw your own contributions, the amount you put in, tax-free and penalty-free at any time for any reason. The penalty and taxes would only apply to the earnings portion of a non-qualified withdrawal.